A few years ago, one of the largest financial firms in America ran an internal study on its own clients. They wanted to know which type of account, out of millions, generated the highest returns over a 10-year period. Was it the day traders? The hedge fund clients? The ones with finance degrees? It was none of them. It was the dead ones. The single best performing group of investors at this firm were the clients who had passed away. The second best were the clients who had completely forgotten the account existed. That is not a joke. That is the data. If the best investors in America are dead people, what exactly are the rest of us doing wrong? Two men, same age, same $55,000 salary, same $50,000 in the bank. The year is 2005. They have 20 years to get rich. Jake takes his $50,000 and buys a rental house. He calls himself an investor. Marcus takes his $50,000 and dumps it into an index fund. He sets up an automatic deposit of $300 a month and then forgets about it. What neither of them knows is that they are about to walk into the worst financial decade in living memory. 2008 is coming. 2020. 2022. April 2025. 4 crashes. Across 2 decades. Wiping out trillions of dollars at a time. By the end of those 20 years, through every crash, every panic, every headline screaming, "This is the end," one of these men ends up with $610,000 in liquid wealth. The other ends up with $450,000 in equity, a back full of stress and stories he does not like to tell at parties. And the man who won was the one who did the closest thing he could to being dead. First, you have to understand what a crash actually is. On April 3rd and 4th of 2025, in a 48-hour window, $6.6 trillion of global wealth evaporated. The largest 2-day loss in market history. 2 days. Trillions gone. Pull the camera back. In 1929, the broad US stock market dropped 86% and did not return to its previous nominal high for 25 years. In 2007, 57% in 18 months. In March of 2020, 34% in 33 days. 2022, 25% in 9 months. April 2025, 10% in 8 days. Crashes are not rare. Crashes are normal markets. Since 1928, the broad index has spent roughly 40% of all trading days in some kind of drawdown from a previous peak. 40%, almost half. If you are waiting for a calm market to start investing, you are waiting for a unicorn. So let us walk Jake through it. Year 1, 2005. $50,000 down on a $250,000 house in a Sunbelt market. Phoenix, Tampa, pick one. 30-year mortgage at 5.9%. After taxes, insurance, and maintenance, the property cash flows about $300 a month. He feels brilliant. 3 years pass. Then 2008 happens. His house, worth $250,000 at closing, is now worth $175,000. His original $50,000 down payment is wiped out. He owes the bank more than the house is worth. He is, in financial terms, underwater. Then his tenant loses their job, stops paying. The eviction takes 3 months and costs him $7,000. The house sits empty. Jake has to write a check every month out of his $55,000 salary for the mortgage, the property tax, and the insurance, while the house is worth $75,000 less than what he paid for it. He calls his bank to tap his home equity line of credit, the emergency credit line every real estate guru tells you to set up. The bank has frozen it. Solvent borrowers, perfect payment histories did not matter. Jake is on his own. He is one of nearly 15 million Americans who received a foreclosure filing between 2007 and 2012. By the end of 2009 alone, 3.96 million filings. 1 in every 45 homes in America. Jake survives. Barely. Second job. Drains his retirement account. Keeps the house. By 2012, the bottom is in. Over the next 13 years, his property climbs from $175,000 all the way up to roughly $600,000. By May of 2025, his equity sits at about $450,000. $450,000. That is the number on the spreadsheet. The spreadsheet does not say anything about the second job, or the eviction, or the night he stared at the ceiling at 3 in the morning trying to figure out how to make the next mortgage payment. The spreadsheet never says anything about that. Now Marcus, same starting point, 2005, $50,000 into a broad index fund, $300 a month on automatic deposit. He set it up once and went to live his life. 3 years pass. Then 2008 happens. His account drops 57%. On paper, more than half his money is gone. The headlines are screaming. His coworkers are panic selling. His brother-in-law tells him at Thanksgiving that he is an idiot for not pulling everything to cash. During the peak panic of October 2008, retail investors yanked record amounts of money out of the market, locking in the worst possible price. Marcus does not do that. Marcus does not do anything. Marcus does the most powerful thing a stock investor can do during a crash. He does not look. His automatic deposit keeps running. Every month, $300 goes in, at prices 40 and 50% below where he started buying. He is, without thinking about it, accumulating cheap shares while everyone else is selling them. By 2013, the market has fully recovered. Marcus is ahead. Then 2020 hits, down 34% in 33 days. Marcus does nothing, recovers in 5 months. 2022, down 25%. Marcus does nothing, recovers in 18 months. April 2025, down 10% in a week. Marcus does nothing, recovers in 2 months. By May of 2025, his account is sitting at roughly $610,000. He has put in $122,000 of his own money over 20 years. The other $488,000 is the market doing what the market does when you let it. He won by being, functionally, the closest thing he could be to dead. Now here is the part that breaks people's brains. Because most people, when they hear this story, do not say I should have invested every month like Marcus. They say I should have waited for the crash. I should have bought the dip. So let us run that experiment. A data scientist named Nick McJulie ran the actual numbers, going back to 1920. 2 strategies. Strategy 1, mindless, like Marcus. $100 a month, every month, no matter what. Strategy 2, omniscient. The investor has the literal supernatural ability to see the absolute lowest point of every market crash in history. They sit in cash and only deploy at the perfect bottom, with perfect knowledge of the future. Pause for a second. Think about how unfair that advantage is. Knowing the exact bottom of every crash for 60 years. You should win by a mile, right? Wrong. Across 40-year periods, the omniscient market timer loses to the mindless monthly investor 70% of the time. With perfect knowledge of the future, the God-tier investor still loses. Why? Because the market spends so much of its life going up. Every month, the omniscient investor sits in cash, waiting for the perfect bottom is a month they are missing the slow, boring compounding that quietly happens on most Tuesdays. There is so much opportunity bleeding out that even being right about every single crash for 40 years cannot make up for it. If you are waiting for the next crash to start investing, you are not being clever. You are doing worse than God. There is a second study that drives this further into the ground. 5 investors, each one puts $2,000 a year into the market for 20 years. The only thing that varies is when, inside the year, they invest. Investor 1 had perfect timing, bought the lowest day every year. Final value, $87,000. Investor 2 invested on the first trading day of every year, $81,000. Investor 3 split it into 12 monthly deposits like Marcus, $79,000. The difference between literal omniscience and a robot was about $7,000 over 20 years. Functionally, nothing. Then there was Rosie. Rosie had the worst timing in human history. Every single year, for 20 years, she invested her $2,000 on the exact peak of the market, right before every crash. Every single year. Final value, $72,000. And then there was Larry. Larry was the smart one. Larry watched the news. Larry said the market is too high. I am going to wait for a crash. Larry never bought. He kept his money in cash. Final value, $51,000. Read that one more time. The investor with the worst luck in recorded history beat the cautious cash hoarder by $21,000. The cost of waiting for the perfect moment is bigger than the cost of having the worst possible timing. Cash is not safe. Cash is the slowest wealth destruction tool ever invented. Now I owe Jake, a steelman, real estate in a crash, is one of the greatest wealth builders in human history. For one very specific kind of person. While Jake was barely surviving 2008, Wall Street was doing the opposite. A single private equity firm spent roughly $10 billion buying foreclosed houses across America for fractions of what they were worth at the peak. By 2024, that firm controlled the third largest single-family rental portfolio in the country. 61,000 homes. If you had $100,000 in cash in 2011 and walked into a Phoenix bank and bought a foreclosed house, you printed money. No mortgage, no leverage, no margin call, 6 to 8% in immediate cash flow. Then a decade of 3 times appreciation as the city recovered. But notice the pattern. The people who got rich in real estate during the crash were not the leveraged retail investors. The leveraged retail investors got foreclosed on. The people who got rich were the ones with cash, with no debt. Real estate works in a crash. It just does not work for the version of you that needs 5-to-1 leverage to even play the game. Now back to Marcus. There is one more number you have to see. Over the 20 years ending in 2024, the broad US stock market returned an average of about 10.4% per year. The average stock investor in America earned 9.2%, a 1.2% gap. That sounds tiny. Over 20 years, that gap is roughly $200,000 on a $600,000 account. A quarter of all the wealth vaporized. Not by a crash, not by Wall Street, not by fees, by the investor's own panic. Behavioral finance has a name for this: the behavior gap. The difference between what the market gives you and what you allow yourself to keep. In 2024 alone, the broad index returned 25%. The average investor captured 16.5%. They missed 8.5 percentage points in a single year by trying to be smart. And the reason is biological. Behavioral economists have proven that the pain of losing money feels roughly twice as strong as the pleasure of gaining the same amount. Twice as strong. So when your account drops 34% in 5 weeks, your brain is not processing it as a temporary paper loss. Your brain is processing it as a threat to your survival. And under threat, your brain runs. It sells. It tells you, with absolute conviction, that this time really is different. This is why investors who automated their portfolios did better during the 2020 crash than the ones who managed their own accounts. The automated investors panicked at a rate of about 1%. The self-directed investors panicked at a rate of about 11%. The only meaningful difference between those two groups was whether they had to push the buttons themselves. Take your finger off the button, and the button stops betraying you. So here is the reframe. The reason Marcus beat Jake by $160,000 over 20 years is not because index funds are magic. The reason is not because real estate is bad. The real trap was never picking the wrong asset. The real trap was assuming you could think your way through a crash. Jake got punished by leverage. Marcus got rewarded by removing himself from the decision. The clever investors in between, the ones with the news app open and the chart on the second monitor, paid the behavior gap and never even saw the bill. Compounding works. Crashes are temporary. Panic is permanent. Which brings us to the actual strategy. The thing in the title. When the next crash hits, and it will, here is what the math says to do. 1. Do not stop your monthly contribution. A 30% crash means your same monthly deposit just bought you 42% more shares. You are not losing money during a crash. You are buying a sale. Pausing during a crash is the single most expensive mistake retail investors make. 2. If you have a tax-deferred retirement account, look up something called a Roth conversion. When the market is down 30%, you can convert it for 30% less in taxes. Then every dollar of the recovery comes back tax-free. A crash, weirdly, is a sale on your future taxes. 3. If you own anything in a taxable account that is down, talk to an accountant about tax loss harvesting. You can sell the losing position, immediately rebuy a similar but not identical fund, and use the realized loss to offset up to $3,000 of ordinary income. The crash itself becomes a tax credit. 4. Keep a 1 to 3 year cash reserve, separate from your investment account, that you live off of if your job goes away. This prevents the only thing that can actually hurt a long-term investor: being forced to sell at the bottom because you ran out of money for groceries. As long as you are not a forced seller, the crash cannot beat you. 5. Do less. Look at your account less. Read the news less. Make fewer decisions. Be more boring. Be, as much as legally possible, dead. Here is the honest summary of everything you just heard. The single best performing investors in America are dead people. The second best are the ones who forgot the account exists. An investor with literal supernatural foresight loses to a robot 70% of the time. The worst market timer in recorded history beat the cautious cash hoarder by $21,000. The average investor leaves a quarter of their wealth on the table by trying to be clever. Every one of those data points is pointing in the same direction. The strategy that gets rich when the market crashes is not the strategy that figures out the crash. It is the strategy that does not flinch during the crash. Marcus did not have a higher IQ than Jake. He did not have better information. He had one advantage and one only. He had set up his account in such a way that when the panic came, he could not act on it. He took the steering wheel out of his own hands before the storm, and the storm came 4 times, and he still ended up with $610,000. So look at your own situation, right now, today, and ask yourself one question. If the market dropped 30% next Monday, what would you do? If the answer is anything other than nothing, you have not built a compounding strategy yet. You have built a guess. The difference between Marcus and almost everyone else watching this video is not how smart he was. It is how little he had to decide when it mattered. The next crash is coming. Nobody knows when. That part does not matter. What matters is whether you have built a system that survives it without your permission. Because the moment you have to ask your own brain whether to hold or sell, your brain has already started calculating the wrong answer. And the next video answers a question most people refuse to ask out loud. What if the recovery does not come in 5 months? What if it does not come in 5 years? What does the math look like in the worst possible scenario? The one nobody wants to model, where the recovery takes a full decade or longer. The answer is uncomfortable, and it changes the whole strategy.